Dutch Tulip Mania. In 17th century Holland, tulip prices skyrocketed due to speculative buying. This created the world's first financial bubble. Tulips first appeared in Europe in the 16th century via the spice trading route. Their value pretty much came from the fact that they didn't look like any other flower on the continent at the time. They became a luxury item, and as the value grew, around 1634, speculators began jumping in the market. Tulips would become so valuable that one bulb would cost as much as a house, with the best tulips costing upwards of $1 million in today's money. However, in February 1637, the market collapsed almost overnight, leaving many bankrupt. The South Sea Bubble. The South Sea Company formed as a way for Britain to reduce the cost of the national debt. The income was expected to come from slave trade between Britain and South America, because South America was known for its excess of gold, but the profits never materialized, and instead, the company started acting as a bank and lending to purchasers. This drove the stocks up, in turn creating the bubble. Even a lot of the British high society invested in the South Sea Company, and when the bubble burst, a lot of investors lost their money, including Isaac Newton, who some sources say he lost up to $40 million. The Panic of 1837. This was basically a real estate bubble that took place in the US when investors speculated on land that was open to settlement after the removal of Native Americans. Speculation on timber in Maine was amongst the most extravagant. Partner this with banks lending money pretty freely and you get a bubble. Banks were issuing banknotes without restraint, and this would backfire when President Jackson mandated that payments for land be made in gold or silver. And when the banks refused to redeem their notes, everything collapsed. The Great Depression. This is one of the most famous financial crises. The Great Depression was ultimately a result of the Wall Street crash of 1929. In the 1920s, the markets were booming, and a lot of people borrowed money to invest in stocks. But when the market crashed at the end of the decade, it caused a worldwide economic downturn. This caused factories to shut down, unemployment would rise, and it took years for the economy to recover. This would lead to lasting reforms like Franklin Roosevelt's New Deal program. Ultimately, it was the manufacturing production increases of World War II that ended the Great Depression. The oil crisis. This crisis was the result of the Arab-Israeli War, in which the Organization of Petroleum Exporting Countries established an embargo on oil for the U.S. because the U.S. supported Israel. This would cause gas prices to rise and inflation to kick in, leading a global crisis. In 1973, Henry Kissinger would start conversations with Arab leaders and eventually help with the first Egypt-Israeli disengagement agreement. This would ultimately bring a lift to the embargo in March of 1974. The Japanese asset bubble. This crisis was characterized by an economic boom that took place in Japan in the 1980s when Japan's economy was booming. At this time, their economy was the second largest in the world. This caused an explosion in stock, land, and credit prices. In the early 1990s, the bubble burst and Japan went into a period known as the Lost Decade. The Asian crisis. The 1997 Asian financial crisis began in Thailand and quickly spread to other Asian countries. There's a few reasons for this crisis, and they're typically debated, but the main issue being a sequence of currency devaluations. It started when Thailand ended its peg to the US dollar, in turn causing the currency to fall. This became a domino effect as Malaysia, the Philippines, and Indonesia all began to let their currencies fall. This would continue to spread throughout Asia, with some countries like Hong Kong being able to withstand the crisis. The dot-com bubble. One of the most popular modern-day financial crises. It was characterized by the quick rise in technology stocks in the US. The valuations of these companies were through the roof, and most of these companies had no true intrinsic value. The birth of the internet brought in the rise of many internet companies and a lot of investors pouring money into those companies, even though they had no real profitability. Equity markets grew during this time, but when equities went into a bear market in 2001, most of these companies went bankrupt. The 2008 financial crisis. Another more modern crisis. This crisis was fueled by cheap credit due to loans being given to people who were not credit worthy. These loans were called subprime loans. This inflated the housing market and would eventually bring it to a bust in early 2006. Two big Wall Street banks would end up collapsing, Lehman Brothers and Bear Stearns. Ultimately, this crisis would end up forming the Dodd-Frank Act, which was the government's way of attempting to reduce predatory lending. The COVID-19 crisis. When the pandemic hit, economies around the world shut down. Millions of people lost jobs, and governments had to act quickly with stimulus checks and support programs to keep things going.